I'm slightly questioning the outlook stable bit, Ben, but it does seem as if we kind of got what we expected and we can fade the move that we've seen in French bonds. Is that really the narrative here?
Morning, Guy. Yes, I think that is the denouement here. I think the downgrade was a long time in the making. You've got deficit that is running well above 5%. And Fitch said over the weekend that they expect that to stay that way next year as well. And if you look at the debt to GDP of France and the deficit, both are running at nearly twice the EU mandated levels. The EU wants them pegged back to 3%, but we are not going to get to 3% anytime soon. So France has been trading at a discount to Italy and Greece, and both our nations rated several rungs below France. So the bad news, you could argue, Guy, is already largely priced in, which is why you're seeing a muted reaction at the start. And the silver lining in all this, as you mentioned, is that Fitch has pegged the rating outlook at stable, which means that they don't expect a change over the course of the next year. And with all its problems, France is still trading is an A+ debt. And I think that, investors are going to take heart from there. And the point is, it's not that French bonds are going to rally from here. It is that they are going to trade with a mild risk premium, but that's about it.
Ven, when it comes to the Fed decision on Wednesday, what's the key thing you're watching for?
Well, I think that they've got an easy part and a tough part. The easy part is what everyone expects, the 25 basis points rate cut done and dusted, I think. But the tough part is what they really do with the dot plot. And they indicated 3 rate cuts to 2026 in June, Kriti. So now the markets are already moved beyond that. The markets are saying 6 rate cuts by the end of 2026. So the Fed will have a challenge in pegging the markets where it wants to be. And of course, this all comes in a context where if you look at inflation swaps, the markets are pricing in 3.5% inflation or thereabouts in the next 1 year. So it's not going to be an easy thing for the Fed to be cutting rates when inflation expectations are so elevated over the short term.
Where does the volatility come from this week, Ven? The Fed looks like we're going to get 25, but 50 maybe would deliver some of that. We'll wait and see. Is it from the Bank of England? Maybe, maybe not. Where do you see volatility emerging from this week?
I think that, a lot of volatility should be expected from the Bank of Japan because on the one hand, we had the trade uncertainty that is removed now. And I think that, we have signs that the next incumbent for the Prime Minister's post could be someone who is fiscally dovish. And that sets up the Bank of Japan to be raising rates. And if they kind of drag their foot on raising rates, I think that the markets won't like that, and you will see a lot of volatility coming from JGB yields spiraling, and that is not a good message for the rest of the global markets, the rest of the global bond markets, especially the gilts.